Balance your trading strategy by adding futures. CME Group helps you manage risk and capture opportunities in all market environments. Capitalize on around-the-clock access to highly liquid global futures and options market across all major asset classes. Just visit your online broker and get started. Plug into valuable educational materials and trading tools and see what adding futures can do for you at cmegroup.com/on-the-tape.
All right, listen, it's 9:31. The market just opened. I'm here with Wolf Financial Stock Market News. My main man, Guy Adami, who's working a chairlift or a forklift or some sort of lift. We do these trading spaces. You guys do yours. What do you guys call what is yours generally, your stock chats? What do you guys call them?
We come up with different names for all of them. We've got our Monday morning ones, which was Good Morning FinTwit. We have, all different types of stuff. Whatever name we can throw at it. Play of the week, Power Hour, whatever.
Well, I like it. You guys are doing a lot of great content, and you're building a really nice community, and you're bringing a lot of really interesting voices. And one of the things that, Guy and I, who've been doing a lot of our own content for a while now, and we've been doing it on CNBC. I always find it really refreshing to get some different voices, some people who approach markets from, a non-institutional sort of fashion. And you guys have built a great audience and a really nice community. So it's our pleasure to do this, you guys, today. A little different vibe this morning in the markets. I see a lot of green. I don't see rip roaring, it's not like one of those squeeze days. Remember last week we had that rip, maybe was it Tuesday, where the S&P was up 2%, the NASDAQ was up a little more, and things were just ripping your face off if you were short. Today feels a little less. It seems non-convicted. What are you guys seeing? What are you thinking?
I hope that it really does hold here off the bat. Pretty worried about giving up those January 24th lows that we were seeing, and I think the Qs are pretty damn close to them.
Hey,
SPY's
I
not
gotta
too far
let
off.
you in. I gotta let you know a
dang.
little secret. That's happening. They're gone. I mean, I'm not saying it's going to happen today, but we don't, in my opinion, we just haven't had all this kind of back and forth, and given everything that we know why the markets have sold off, that those lows are going to hold. I mean, it's just, I think there's going to be lower low. I think we're kind of in a one step up, two steps back. And I gotta say, Guy said this last night on Fast Money, and I think he's still listening here. It's like,
no, I'm here.
Hi,
I
Guy.
apologize.
Well,
I got away from the forklift.
I want to. You said this, and maybe you can expand on it. You said actually the healthiest thing might be right for lower lows for the stock market. Explain that, because stock market news, or he just said, well, I hope they hold the January 24th lows, and I'm just curious your take, Guy, on that.
Yeah, I mean, listen, I guess I do as well. I mean, I understand. Trust me, nobody understands more than I do that 99% of people want stocks to go up in perpetuity. I get it. But we've learned over the years that although it seems that way, and for the last few years, it obviously seems that way, that really is not the reality of the situation. And you need to have these pullbacks for a number of different reasons. You need to flush some weak hands out. You need to create new opportunities for new people that feel that they missed the run that typically would chase. Maybe they have better entry points. I just think it creates for a healthier environment. It's not unlike, by the way, forest fires. Like you need forest fires for the old trees to burn down, new trees to grow. And if that is left unattended for a period of time, those fires get that much worse. And my point is, if the market just goes up every single day, the sell-offs that are inevitable become that much worse. So in my opinion, what you want to see right now is this flush, if not down to 4,000, that 3750 level to me makes a lot of sense. So again, I'm not wishing it, but I just think inevitably we'll talk about 6 to 8 months from now, that was the best possible thing that could have happened.
Yeah, get in there, guys. I'm just curious. And again, I think that you weren't making the point like, this is it. This is the point in which it has to happen. It was just we've become accustomed in the age of like QE or Fed puts as really, in 2018 in Q4 when the stock market started selling off, we almost ticked 20% peak to trough decline, and the Fed changed their tune. Now, this time it's going to be very different because they just don't really, after years of QE now, 2 years, and unusually low rates and unusually like dovish speak, they've basically turned on a dime in the last few months here. And for them to change the other way would be a problem that the stock market was pushing them around. So I'm curious you guys' takes on Guy's view on that.
I think it kind of goes back to the term like "don't fight the Fed." For the last 2 years, it's been "don't fight the Fed." Even more than that, "don't fight the Fed" on the way up. And I think we're about to see that over the next couple months. Don't fight the Fed on the way down. And you know, how long is that going to last for? My perspective. I'm 23, long-term investing. I have 10-year plus time horizon. I think this is done within the year. Markets are forward-looking, and we still might have this quantitative tightening for more than a year, or interest rates going up. But the market, I think, will digest it pretty quickly. What's pretty quickly in the grand scheme of things in the market? I would say a couple months, 6 months, whatever it is, max. So, I think this broad-based market selling creates opportunities in select names, and we'll see that going forward. Last year, speculation was so high, probably 2 years ago, but and we're just seeing a rebalancing of that. And it's interesting to see a couple names that haven't been knocked off as much as I would think, as we've seen this broad-based selling. So, my perspective as a long-term investor, I have taken the opportunity to buy small amounts in dips, quote unquote dips, Facebook and Google. But, I think that the market really has difficulty handling more than one headwind at a time. And this Russia-Ukraine plus the Fed, I think, has kind of caused us in this area from we were in chop for a while, I think, dealing with the Fed, to where we're kind of in this pullback period. But, I think the market is slowly digesting the Fed more. And I think I see around the summer us getting back to where we were. But I think that once we get past this Russia-Ukraine situation, we will chop for a little bit more. So I don't know how much more down period we have in my head, but I do see us kind of chopping around and not really going up for a little bit. So my short term, medium term, next 6 months, I'm not super bullish, but from my perspective as a 10-year plus time horizon, I am taking that opportunity to
Yeah, but
slowly add. And whenever I see QQE
I'm gonna
down
push
50%,
back at you, my
go
young
for it.
friend. I don't know anybody other than Kathy Wood who has a 10-year time horizon. I mean that very sincerely. I mean,
Yeah.
it's really easy to say that's what you have, but like for instance, you could have said that about buying PayPal at $300, 7 months ago, and here's the stock at $100, and at sooner or later some risk management has to kick in. You know what I mean? So I think time horizons are moving targets when it comes to investing, especially in kind of markets like this that have been obviously at times propped up by really easy monetary policy, disregard for valuation, all the above. So I'm just saying, like, 10-year time horizon, fantastic. And this might be the buying opportunity of the century here, but you could have made the same point 6 months ago, and it would not have been, and the one thing I'll just say is this, and God, I'd love to get your take, is like, if in 2018 the stock market sold off 20% because rates were going higher and there's a growth scare, and maybe I'm missing something else. Well, the S&P is only down 10% right now from its highs, and we have dozens and dozens, maybe hundreds of stocks in our stock market that are down 50%. So you've had an all-out crash in large parts of the stock market, yet the larger, the broader market has not really, has not done that. It's barely corrected, if you will. And maybe that is because, this continued concentration, maybe that was the thing that ultimately saved it, the thing that I thought would be the thing that took it lower. So that's the debate right now. What happens from this moment on in Apple and Microsoft and Alphabet and Amazon? And, we already saw Facebook is down 50%. Nvidia is down, 30 some percent. Tesla is down 30 some percent. So if all of those stocks were to go down, we're in a bear market, and there's no V reversal coming back from that. In my opinion, it's going to take some time to work that out. Guy, any thoughts there?
Well, I think time horizons, I totally get it. And I'm a huge fan of what you're doing without question. And I'm not here to cast aspersions in any way, but what I'll say is, I think what we've learned over the last few years, things move over the course of months the way it took, 8 to 10 years prior. I mean, stocks shouldn't move. Stocks the size of Facebook that Dan just mentioned shouldn't move 40% or so in a month and a half. It's just, it's not particularly healthy. So a lot of times over a 10-year period, you might have been looking for a 40% gain or thereabouts. Now you're getting those gains and losses in the course of months. So I think time continuum has changed given what the market's doing. So although I understand what you're saying in terms of wanting to wait and be in it for the long term, there are situations where, if stocks going to move again 35-40% over the course of 2 weeks, what's wrong with taking profits if you're long that instead of waiting the commensurate 10 years? So I just think in terms of time, I think that entire thing has been skewed, and to a large part it's been skewed, in my opinion, by the largesse of global central banks that are now trying to extract themselves from a situation that I don't think they're going to be able to extract themselves from.
Yeah, there were two tweets I saw this morning. I just retweeted them, and Ryan Dietrich, I think, is at LPL. The S&P 500 officially moved into correction territory again. None of us really give a shit about that. This is a 33rd correction, though, or bear market, so that would mean 10% decline, at least since 1980. And he's saying, take note, they aren't fun. No one likes it, but the 1-year return later is nearly 25% and higher 90% of the time. So that's good data. I mean, there was also a similar tweet from a woman named Sarah Posnek. I think she's over at UBS with a similar sort of stuff. So we're getting to that period where I think people are like, all right, this could get real. And how do we think about things, a year out or so? Hey, stock market news. What's your take like on the time horizon thing? I mean, obviously, Wolf just said he's taking a 10-year. And again, I mean, listen, I'm sure that here's the thing about a 10-year time horizon. That would make sense in a broad market indice. It's really hard to do that on an individual stock. Look at a stock like Facebook, which is now down 50% or so, 45% in just the last few months or so from making an all-time high. This is a mature company, you know what I mean? And obviously one of the reasons why the stock has come in is that 10 years into their mobile shift, right? Based on a couple of the apps that their initial, Blue Page and then Instagram, and then some of the other things that they've stolen from Snapchat, Reels, and all this sort of stuff, WhatsApp. People are really questioning what the future of this company is. So to have a 10-year time horizon on Facebook, it seems, yeah, I'm being patient, but who knows, man? This company really, what they just laid out with the Meta thing tells you they're scared shitless about what their existing business is and how to monetize what this changing, mobile, kind of internet environment looks like going forward, because it doesn't look like the environment when they went public in 2012. And obviously the metaverse or whatever that is, or whatever they think their version of the metaverse is, it's going to be monetized very differently than the way their Blue Page was.
All you, Wolf.
Yeah. So that was Evan, stock market news with the 10-year time horizon. I've been definitely on a shorter time period, and when you're looking at SPY here, I hear you, Dan and Guy. It would be interesting to have a drawdown here. I've been kind of waiting for it to fall to 410. I think it's kind of destined to fall back to 410. One of the more popular indicators that I use is a anchored VWAP. And when you go back to September 3rd, where then it really had that kind of that real run after the dip from there, that's where a lot of people have their average price at. And so I think we're kind of destined to come back down a little bit towards there. But my concern is, you just pointed out, Dan, actually, that we had so many stocks that have taken 50, 60, 70% haircuts. And I'm curious, if we fall below a couple more key levels, certainly if we get below even 400, do we see the indice have a similar type correction? Is that possible? Because so much stuff has given up, all of its COVID gains, which would be coming all the way back down to, around 340. And I think, with this intense run-up we've seen over 2 years, it's not unreasonable to think that could happen, a big drop. And I just, for myself, I'm fine with it. I think if it picks a direction one way or the other, I actually trade on a pretty short time period, and I don't mind, buying puts and things along those lines. But I think for a lot of retail with their long bias, it's going to be pretty rough if we see a big fall to those levels.
No, I think it's fair. I think you make a great point in terms, and Dan has brought this up a number of times. The only thing that really hasn't moved in a meaningful way has been the broader markets in the form of the S&P and the NASDAQ. And, there's some people that say that shows how resilient it is, and I get that. And there's the other school of thought that it's just a matter of time before they catch up to what some of these individual names have done. I'm sort of find myself in that school of thought. And again, I've said this, so I'm not splitting the atom here. I'm not breaking any news, but David Tepper will come on the network and he will say, very simply, and to the point where it's sort of almost agitating for me, if the Fed's adding liquidity, why fight the Fed? He is the flag waver of not fighting the Fed. And under those circumstances, if you're bearish, you're fighting the Fed. So if you're bearish when they're adding liquidity, you're fighting the Fed. So it stands to reason that when the Fed does a complete 180, which they have, and I think they will stay on this path, again, just my opinion, if you are bullish now, you're effectively doing exactly that. You're fighting the Fed. So I think the paradigm shift is here. And I think today's going to be a fascinating day to see how the market trades. But I think we find ourselves in an environment now where people are looking to sell rallies more than they are looking to buy sell-offs.
Yeah, one thing I would say, and Guy makes a good point about just what, basically the fact that the S&P is down 10%, and it did make a new high, I think, in the second trading day of the year. The NASDAQ never confirmed those highs. The NASDAQ, at its lows in January was down 17, 18%. That got really sloppy, and that meant obviously that some of the biggest components were not trading particularly well. But Apple has traded really well, and we know as the largest component of the NASDAQ and the S&P 500, that certainly helps here. But I just say this, I mean, look at the XP, if you look at the NASDAQ composite, you get back to 13,000, that's a 20% peak to trough decline. And I would say at that point to get there, because so many of the stocks in the NASDAQ have been absolutely bludgeoned, you're going to need those larger names to kind of kick into the downside a little bit. And that would be the point, where you might start picking at these things with more of maybe an intermediate term time horizon. You will get some really like awesome little short squeezes. And really, I guess the issue that a lot of new entrants to the markets have to consider, the last two times that we have seen asset bubbles burst in the stock market, we have seen protracted bear markets. Okay. So the market topped out in the spring of 2000. The Fed was raising rates. It did not bottom until October in some parts of the market, until October of 2002 and spring of 2003. And it also took a little bit of a war there. And then also then May of, or the spring of 2006 or summer, they were hiking again. And we had an asset bubble in housing and then related financial products. The market topped out in November 2007, didn't bottom until spring of 2009. So the bear market we had in February, March of 2020 was obviously a black swan event, and the Fed and the Treasury and Congress, I mean, they hit it with trillions and trillions, and we had a V reversal. I think that was probably the worst lesson long-term, like new entrants to the market and people who want to take a long-term view on markets could have ever had. And one was just a free-for-all in the broad market, yet we had massive bear markets and big sentiment pockets of the market. So to me, 2022 is going to happen no matter what you thought was going to occur on the geopolitical front, because when you're again hiking to avoid the furtherance of asset bubbles. I mean, at least the 20-year history of that does not prove too well. I mean, that's just, and you can tell me it's different this time. If anything, what's different this time is much worse when you think of central bank balance sheets, and we're literally into our third crisis here, and the Fed and their ability to kind of orchestrate orchestrate the sort of economy that they love to have. And Guy, you talk a lot about this. I mean, when you think about, I think you said it on one of our shows yesterday, they're given all the data that they have and where they sit and their inability to forecast, the economy. It's like, why do you think that they'd be any good at doing the markets either?
Well, that's exactly right. I mean, what gives you any confidence in them whatsoever? And again, I hope most of you, I'm sure, know this, but it's worth saying in case you don't, because I'm big on full disclosure. I am not a fan of the Federal Reserve at all. I think they've totally screwed the pooch on this one in a major way. And I think we're all going to be worse for wear. And I don't say they're malicious people, bad people, but history is littered with disastrous outcomes born of good intentions. But, with that said, just think about this for a second. These are people whose judgment we rely upon. I mean, we as citizens of this country rely upon the judgment of these mostly men, some women, to get us through things. Okay. I mean, I think we all agree with that. Well, for many of these people, they didn't have the good judgment to understand it. Although they were allowed to trade securities and stocks, maybe the optics of that were not particularly good. So the fact that they didn't have the foresight, or to use the word for the fifth time, judgment not to do it, if they're not smart enough to see that, I got to tell you something. I would have seen it. I would have been like, you know what? Just doesn't pass the smell test. And I'm not the brightest bulb in the fixture, as Dan and the rest of you probably know. So again, the fact that we trust these people when, their judgment, when none of them have proved to have any judgment whatsoever, is really troubling. And now they're going to try to navigate us through the biggest prop trade in the history of mankind. And quite frankly, they're not going to be able to do it. And it's going to have, and I'll use this word by choice, catastrophic outcomes.
Whoa. All right, let's talk markets here really quickly, Guy, because I got to hop at the top of the hour at 10 o'clock. You probably do too. These guys are much better talkers than we are here. But, a couple names that are on my radar today. Last night on Fast Money, Guy, we were talking about Palo Alto's really good quarter, good guidance. Stock was up 7-8%. Now it's up 5%. One of the kind of hallmarks of some of the good results that we've seen in the last couple of weeks is gap fills. I think that Alphabet gap fill was probably the nastiest thing I've ever seen. I think the NVIDIA quarter and guidance last week, which was really good, and the stock subsequent 10% sell-off over the next couple of days was really bad. Disney filled in a little of its gap. I mean, that's been just a theme, right? If we look around, Upstart filled in. I don't know what they do, but I know that stock had a big gap
You don't know what
last
they
week.
do?
No,
Oh, that's odd.
I'm sorry
Don't
to
ask
talk.
him.
I
The mic
know.
might start cutting out.
Sorry about that. Wait, what? I can't hear you. So let's see if some of these stocks, can hold these gains. The other one is TJX, reported this morning, stock's down 7%. And I didn't really get a chance to look at the numbers, but that's making a new 52-week low. That stock has been range bound really between like 63 and 77 or so for the last year. Just a lot of bad price action all over the place. The other thing I'd mention, and maybe these guys have a view, Tesla gave up yesterday. I thought that was really interesting. Tesla was, like really flirting with that $800 level. It feels like someone was just sitting there trying to hold it up. And if you go back, from its breakout in October, just above 800 and went straight to like 1200. I think 800 psychologically might be kind of a really interesting level. Curious, guys, on some of those names or other names that you're watching to kind of give a sense, because I see the market failing here. And also the other point is, I feel like today's the day, or very soon, we're going to see Apple and Tesla and a couple of these other names get a little sloppy. And that's where you maybe get capitulation in the broad market.
TJX is, and I got to hop in a minute. Unfortunately, I'm sorry, but you're right on TJX. I mean, we're 52-week low here. It's, to me, I mean, if you look at this level we're at right now, specifically this $60 level, and this was a prior all-time high back, I want to say, in March of 2020. And obviously, we all sort of remember what was going on then. So it's got to hold here. And I will tell you, and Dan and I talked about it last week, NVIDIA, I thought the quarter was great. I thought the guidance was great. The stock had sold off significantly into earnings, and the subsequent price action was shitty. And I say it all the time, good news, bad price action, that tells you something. And I think, unfortunately, that's seemingly what's going on now with a lot of these names, Dan.
One quick one, we've obviously seen energy stocks react to this and commodities to what's going on with Ukraine and Russia. And Guy, you've been pointing out the potential for something there literally to the week you thought would happen. You've been saying this for months. You thought something would happen. And again, you're not like the next coming of Henry Kissinger here or anything like that. But it happened, and the commodities started moving up into it. Electricity prices in Europe have been moving up. Energy stocks here and around the world have been moving up. Do you think that if there's something, and you've also been suggesting that we could see something with Taiwan and China, what would be the knock-on effects there? Would it be tech stocks? Would it be semiconductor stocks? You know what I mean? Would it be a stock like Taiwan Semi, which is one of the biggest fabs in the world,
Yeah.
is the biggest.
No,
So
I
is
think
that ground zero for maybe palpitations from something over there?
think Russia-Ukraine is ground zero for commodities for a number of different reasons. Ukraine, rich country in terms of commodities, minerals, those types of things. And I think China-Taiwan is sort of ground zero for the tech trade. So you put those two together, you have a pretty unhealthy brew, and I'll stand by it. I mean, I'm not wishing this shit, but to me, the Russia-Ukraine thing was about as obvious a situation as you could look to in terms of when it would take place. And you mentioned it. This is not revisionist history. We were talking about this in the fall of last year. And I think China-Taiwan is just a foregone conclusion as well. So we'll see. And again, none of this is particularly bullish for broader markets, unfortunately. But the markets had been on this course prior to this in a meaningful way. Go back again to the fall before anybody really started talking about any of this in earnest.
Yeah, one thing is interesting, and when you think about, kind of the bits versus atoms trade, and especially as it relates to tech, you'd think that some of these internet or SaaS companies are immune to some of these issues. Go back. Remember when Snap had that really bad quarter? Now, obviously, it had a much better quarter that they announced last month. But in the fall, they actually Snap talked about inflation hurting their ad budgets. And I think that's really interesting. It's not something, we know that digital advertising, it's a huge secular story, but you're going to have these kind of fits and starts where some of these companies that rely on advertising, if companies are getting squeezed and they don't have the product to sell and their sales guidance can be lower, they're going to cut back where they can. And that could be digital ads. So I think that is something kind of worth thinking about. Are you guys, Wolf and Stock Market News, are you guys focused at all?
Hey, Dan, I'm sorry to do, but
you got it, Guy.
I apologize, guys.
Yeah.
But I appreciate you guys having us. Really do. Thank you.
Thank you so much, Guy. Have a great day.
Thanks, Guy. Yeah, guys, we'll do it again. I'm running up against 10 o'clock. I got to get on something too. But if China, if Russia, Ukraine were to say have a diplomatic solution, which we kind of all hope they do you guys think that emboldens the Chinese? Is there's something, at least some sort of like provocation that happens in the next couple of weeks? And are you worried about what might happen in the markets?
I'm not as much an expert in that area, but what I will say is, Guy kind of hit it there. The Russia-Ukraine situation is much more commodities-based. How much is it going to affect these other broader companies? But I think the China-Taiwan situation would actually have some impacts on it. So I think if we're seeing how the market is reacting to this situation, I think it would be more. If it's going to happen, I have absolutely no idea, but I do feel the market's reaction would be worse than what we've seen now.
Yeah, and I would just say, I guess my 2 cents there is that it just exasperates, kind of the inflation fears, the supply chain fears, that sort of thing, even if it just pushes it out. And that's really the story of 2021 in a way, is that, in the spring, we're like, all right, rip roaring, we're going to have hot vax summer, all that sort of stuff. Everything's going to reopen. And then Delta clips Q3 GDP massively. And then Omicron, same thing. I don't know if you guys remember September, October, COVID's over. And then we had this wave that just kind of literally was a massive wave across the planet, and Q4 GDP into Q1 clipped a little bit here. So, might these geopolitical situations do the same thing to growth? And that's really kind of, I guess, the real question. Listen, guys, I really appreciate you guys hopping on with us. And, we tried this new time at 9:30. Unfortunately, Guy and I both had things to do at 10. So we appreciate you guys jumping on our trading spaces. We always really enjoy the ones that you guys do. If you're here because of us, follow these two guys, Wolf and Stock Market News. They work their butts off, and they're really creating a great community on their Twitter spaces, and they're doing them basically all day and night. So just turn on spaces, look for them, and learn about what people are focused on in the markets. I love hearing other voices. I'm sick of hearing my voice and Guy Adami's voice, but we appreciate you guys being here with us for Trading Spaces. We also do Market Call, Guy and I, and it streams on YouTube Live, on Open Exchange, and on Twitter. We just launched this at 1 o'clock, so tune in, check out our Twitters today at 1 o'clock p.m. Eastern. We will be doing that. We're going to be joined by Carter Braxton Worth of Worth Charting. So thank you guys for joining us. We really appreciate it. You can find this conversation in our podcast feed, Trading Spaces. Thanks, guys.
Awesome, Dan. We'll have to run it back.
Thanks, guys. Definitely. Would love to. See you later. Bye-bye.
All right. Take care.
Thanks for listening to this episode of Trading Spaces, brought to you by CME Group. If you like what you heard, follow us on Twitter at Trading Spaces and join us live every Monday and Wednesday at 1 p.m. Eastern.